Welcome to the Guide to Investing Part 4, where we look at choosing the right unit trust. Choosing which unit trust suits your needs depends on three key factors: what level of risk you are able to tolerate, your investment time horizon, and what type of returns or repayments you'd like to receive. Risk. Every investment carries some degree of risk. Risk is the possibility that an investment's actual return will be different than expected. You need to decide what your tolerance for risk is. Low levels of risk are associated with lower potential returns, whereas high levels of risk are associated with higher potential returns. In general, your investment time horizon and investment goal will determine the amount of risk to take on. Investment horizon. If you are saving toward a short-term goal, have income requirements over the next 1 to 3 years, or are about to retire in less than 5 years, you can't afford to take too much risk. In this case, a unit trust with a lower degree of equity exposure and higher holding of bonds and/or cash is appropriate for you. If you are younger and are saving for the long term, then you can afford to take on more risk in the form of equities. Investment goals. In general, investors who are looking for a regular income from the unit trust investment are either retired, nearing retirement, or funding a shorter-term expense and would want to minimize the risk of losing money. It would be appropriate to invest in lower-risk unit trusts, which will deliver regular interest payments. Investors who are looking for capital gains want the investments to grow in value over the longer term and are less concerned about the immediate return. An investor with an investment horizon of 5 years or more can tolerate more risk and would invest in equities or balanced funds. These are three factors you need to consider when choosing your unit trusts: risk, investment horizon, and investment goals. It's important to remember that your money also needs to beat inflation to maintain its value. Beating inflation. The value of your savings will be eroded by inflation over time, so your savings need to grow at least at the same rate as inflation to maintain its value. Ideally, it should grow at a rate above inflation. That's why many unit trusts target a rate of growth above inflation. However, the higher the rate above inflation targeted, the greater the risk the fund must take on. For more information, feel free to contact our client service team on 0860 105 775 or email us at info@mng.co.za and one of our friendly investment consultants will gladly assist you. Alternatively, why not try the tools section of our website, www.mng.co.za, where we have a wide range of interactive investment aids to help you with your investment decisions. From saving towards your child's education, putting money aside for that something special, or checking if you are still on track for your dream retirement. Be sure to follow us on Facebook, Twitter, Instagram, and LinkedIn for more up-to-date insights about investing and to access our latest views on financial markets.